Hey everybody, welcome back to the Market Interest, where we talk stocks, finance, and the markets. As I've mentioned in the past, we're in a really volatile market, and I think it's really important for us to be investing in value-oriented companies. Companies that are cash flow positive, paying a dividend, something more stable and reliable instead of way overvalued companies at this time. That's why I invited John Wobensmith, CEO of Genco Shipping, the largest dry bulk shipping company in the United States. Ticker is GNK. John, thanks for being with us here today.
Thanks for having me, Brian.
In the past year, Genco stock is up over 100%, and year to date, they're up nearly 45%. The company just hit the $1 billion market cap just last week, I noticed, so congratulations on that major milestone. And really, just what an incredible year your company has had. So what is it that's attracting investors to your company, and do you believe that this growth is sustainable?
Yeah, so I think from an industry standpoint, I think that is one of the big factors that investors are focused on right now. So we have a situation where there's a very low order book in terms of new ships coming on the water. A lot of the slots have been filled up by container companies. So in order for us, if anyone in the industry wanted to do a new build, you're really talking about a delivery in 2024 or 2025 for that matter. So for the next few years, very few ships coming on, which means that demand only needs to grow by incremental amounts to continue to outstrip the new ships coming on. So that bodes pretty positive for freight rates over the next couple of years. Company specific, I think people are very focused on our value strategy. We've created what we believe is a very good risk reward model by delevering pretty significantly and being able to pay out a high dividend, but also maintaining the opportunity for growth going forward. And then again, on the company front, we have been ranked number one by Weber Research on the ESG front, the environmental side of it, in terms of reducing our carbon footprint and our very high corporate governance standards. I think people are attracted to that.
That's great to hear, especially on the ESG front. I usually don't expect such strong performance to continue, but from what I'm seeing and hearing from you, the company really appears very well positioned for the next couple of years. John, 90% of global trade is held by the international shipping industry, with 50% coming from dry bulk, which is your entire business. So how are you managing risk and diversifying within the dry bulk business? And have you found any ways to create more value by diversifying?
Yeah, so I think, so first of all, just taking a step back, bigger picture, we do believe that in any of these shipping companies that being a pure play is the best way to drive valuation, as opposed to having mixed fleets in other sectors. Investors seem to want to be able to pick a horse in a certain sector or industry and play that. In terms of what Genco's doing to diversify, we have done longer term time charters when the market does move up to certain numbers. We've done some of our Capesize vessels. We've de-risked that by locking in cash flows in excess of $30,000 a day. You'll most likely see us continue to do that, particularly in the larger vessels, which do have quite a bit of volatility from a seasonal standpoint. The other thing is this low leverage model, which allows us, we believe, to pay a dividend in any type of market. Again, we all know there's been a lot of volatility in dry bulk shipping in the past couple decades, and we really wanted to create a company that never ever has to turn off that dividend no matter what the market may throw at you. And the only way to do that is low leverage and drive down your cash flow break-even rate, which is what we've done here.
That's great to hear, especially about the dividend. So last year, you made massive moves to pay down 45% of your 2021 outstanding debt, and I really admire the aggressiveness in paying down the debt. As a financial advisor and working with many retail investors, I've suggested in the past that people should take out a loan or use a line of credit in lower interest rate environments like we're in right now. So can you explain to our viewers why you're so interested in paying down debt in this lower interest rate environment or rising interest rate environment? And wouldn't it make more sense to increase your debt at a time with lower interest rates? I know it's a bit different between a corporation and retail investor, but can you explain?
Yeah, so taking a step back, we announced the value strategy in April of 2021. And we really stuck to our plan all the way through the end of last year, paying off almost half of our outstanding debt at the beginning of 2021 through the end. I keep going back to the value strategy, and the goal is to push down that break-even rate, that cash flow break-even rate, as low as we can, because what that allows us to do is, again, it allows us to pay a dividend in any type of market, whatever the market throws on us, both highs and lows, but it also enables us to pay higher dividends. And we believe that the dividend ultimately will drive valuation at Genco. We have a goal of getting into sort of the 8 to 10% dividend yield. So there's still some work to be done on that. But you also have to keep in mind the first real full payout dividend under this value strategy is taking place first quarter of 2022. So at our next earnings announcement. So we do believe that there is some seasoning that will take place. It could be a few quarters before we get down into those single-digit dividend yields, but we believe that is a goal that's we're focusing on.
That's interesting. And are you considering buybacks as a form of dividend, or just cash dividend at this point in time?
So at this point, we're really focused on the cash dividends, and again, having the model up and running in full. That's not to say that we don't from time to time think about stock buybacks. We have put in place a reserve that builds up on a quarterly basis, and that pool of money has a lot of optionality for the board and the management team, in that it can be used for stock repurchases, fleet growth, as well as potentially smoothing out a dividend from quarter to quarter. So we certainly have thought about it. We've built the strategy to encompass, anything on the capital allocation side.
Now, there are a lot of risks in today's investment landscape between Russia, Ukraine, lockdowns in China, rising interest rate environment. Are these risks affecting your business in any way? And if so, how are you navigating through these challenges?
I think you can focus on a few things right now. China, as you mentioned, are having lockdowns. They're certainly not widespread like we saw in the early part of 2020. They're taking much more of a rifle approach, even within individual cities. But that has affected a little bit in the larger ships and iron ore imports. There is still some slowness in getting iron ore from the ports to the steel mills because of the lockdowns. Which you also have to keep in mind is that Q1 of any year is typically seasonally weak for the larger vessels and iron ore imports due to weather, rains in particular in Brazil. So what we're really seeing right now is it's mostly seasonality. But also, I would say the lockdowns are affecting us. But we believe that's gonna reverse fairly soon here. And China is also in the process of a loose monetary and fiscal policy, and so we believe we'll see a lot more infrastructure spending and building as we get into the second half of the year, which means more iron ore imports and freight rates will move up on the larger ships. On the mid-sized ships, I think it's very focused on the Ukrainian situation right now and Black Sea exports of grains, wheat, and corn, but then also the coal industry. So what's happened in the coal industry is Europe who traditionally would be importing a lot of coal from Russia, have effectively, maybe not stopped yet, but it looks like they're going to. And so they're sourcing coal from much longer distances from South Africa and Australia. So ton miles have been expanding on the coal side, pushing up freight rates and dry bulk shipping. The other, with the price of oil moving to where it has on the high side, it means that the dry bulk fleet in general has slowed down to be more efficient on the cost side and burn less fuel. Again, that has that pushes freight rates up. And then we come to the grain, the wheat and corn that I just mentioned a minute ago. I think it's fluid. I think it's tough to tell what will come out of the Ukraine on the grain side. We do think there is a possibility for the U.S. and Europe to increase production. Again, we're going to have to see how much they're able to do to make up for the lost exports on the wheat and corn side. It's interesting, though, there have been some shifts already. Some of the wheat and corn that has been stored from past seasons in the Ukraine has been shipped out of Romania now. It's not large numbers yet, but the people are starting to figure out, okay, how do we do this from a logistical standpoint? So I'm slightly encouraged by seeing that.
And are interest rates affecting you in any way? The rise in interest rates, is that going to affect your business in any way?
No, look, the debt that we do have outstanding, we have interest rate caps in place. We have for a while. So they're actually in the money from, pretty significantly right now. So our interest cost is hedged fully at this point.
That's good to hear. Well, John, thank you so much for your time today. Before we go, can you tell our viewers why they should be considering investing in Genco Shipping?
I go back to where we were in sort of the beginning. From an industry standpoint, you have a situation where demand will most likely continue to outstrip supply, meaning the number of new vessels that are coming on the water for the next couple years. Then specifically our value strategy, we think we've created the best risk reward model for shareholders in dry bulk shipping with the low leverage and the high dividend payout. It's a first-in-class company, top to bottom, US-based management team, very seasoned, very strong commercial platform that we've put in place over the last few years to outperform our benchmarks, which we've been doing. So I think it's really the full package and the high corporate governance standards I believe shareholders are very focused on.
Excellent. Well, John, thank you for your time today. We really appreciate you jumping on the market interest. We look forward to talking again soon.
Thank you, Brian.
So there you have it, guys. Genco Shipping, the largest dry bulk shipping company in the United States. Thank you again to Mr. Wobensmith for your time. And now, guys, I really recommend you talk to a financial advisor, talk to your money manager, and do a review over the company. See if this does make sense for you. See if this stock makes sense for you. Or if you have any questions, feel free to click the link in the description down below. We can set up a time one-on-one and determine if this is a company that makes sense for you as well. There's multiple risks involved with every company that you invest in, so you just want to be aware of those risks prior to investing. That's all for today, guys. Don't forget to subscribe if you want to stay up to date on the best stocks for this time. Also, go long on that like button. Really appreciate it. And I will see you guys next week. Take care.